Thank you and good afternoon. I'm going to break my talk in three parts today. I want to give my views on gold and commodities. I want to focus a lot of my time on what not to do in the mining industry, what not to do when investing in the mining industry, and I'm going to highlight major mistakes majority of investors make when investing in the mining industry. And once you have sorted that out, I want to talk about the opportunities that exist for investors in the mining industry. The developed world over the last many years has been offering low yields to negative yields on risk-adjusted and on real terms basis. When your returns become zero or negative, that is when people are most motivated to invest in the zero-yielding asset class called gold. Most of the historical gold has actually been bought not by the Western countries, but by the third world countries in the Middle East, and in South Asia and in Southeast Asia. They are the biggest consumers of gold. And the reason is that those economies have historically offered negative yields to their savers. What has been happening is that in the last 30 years, the third world was economically growing. But if you pay closer attention to what's been happening in the third world, their economies are starting to stagnate and their growth rates are coming back to zero. That is when the third world will start paying much more attention to gold as their economies start to stagnate. Also, there's a third reason why gold will start to do well going forward. And I erroneously used the word start, which I'm going to correct 2 slides from now. But this country, China, has been diversifying and internationalizing pretty much for the first time in the modern history. And these people will continue to consume an increasing amount of gold. China consumes anything between 50 to 75% of commodities produced in the world today. And this country underpins the demand for commodities continuing into the future. This is a major mistake most investors make. If they feel bullish about gold or commodities, they immediately translate that bullishness into investing in the mining space. These are two completely different beasts. What these people do, what most investors do is that once they feel bullish about a commodity, for example, gold, they immediately allocate a portion of their money into gold ETFs, for example, GDX or GDXJ, expecting that their investment would produce a leveraged response to gold price. Or they use certain rules of thumb to invest in the mining industry. This is a guaranteed way to lose your money, or at best, it's a guaranteed way to underperform the underlying commodities. You are much better off investing in commodities and gold direct instead of mining, unless you are prepared to do your homework. Let me try to expand on this using this slide. Gold, in most people's opinion, hasn't done well. Gold has actually done quite well in the recent past. In the last 10 years, in US dollar terms, gold has gone up more than 100%. In Canadian dollar terms, it has actually done even better than this. And in the last 5 years of stagnation in US dollar terms that you see would not appear to be stagnation in Canadian dollar terms. Now, when people invested 10 years back in GDX, ETF portfolio of gold mining companies, they would have expected the performance of GDX to be a multiple of this 100% growth that they saw in gold price. What actually happened? GDX actually fell by more than 40% in this time frame. So what was expected to be a leveraged response turned out to be an anti-leverage response. Now, when people invest in smaller development stage companies, their expectation is even higher leverage than they were expecting from investing in GDX. What was the response of GDXJ over this 10-year time period? Even worse than that of GDXJ. And if you assume Canadian Venture Exchange to be a proxy for very early stage junior mining companies, let's look at how they have performed over the last 10 years. And that's what makes a lot of investors very sad. That what makes them think that gold hasn't really performed over the last 10 or 20 years. Gold has actually done very well. It is the mining industry that has done a horrendous job for the investors. What you glean out from the earlier slide is that mining industry is a net wealth destroyer. Even though gold price went up by more than 100% in the last 10 years, the mining industry across the spectrum has destroyed significant amount of wealth of their investors. Particularly the junior mining industry, which has destroyed a much larger proportion of investor wealth than any other sector, subsector within the mining industry. What I want to suggest is that unless you are prepared to allocate a decent amount of time analyzing these mining companies, you should stick with what you feel bullish about, which is the metals. Do not invest in the mining industry unless you are prepared to give time analyzing those companies. Let's first try to understand why the leverage, the expected leverage, turned out to be anti-leverage. When people invest in mining industry, when they invest for leverage, they mostly think in terms of revenue. They would have expected revenue to have increased by more than 100% if gold price went up by 100%. And they would have expected the profitability to have gone up by a several multiple of that 100%. But the reality is that often the cost of mining and cost of processing actually increases faster than the increase in metal prices. And that is the squeeze, the profit squeeze you saw in the earlier slide. But also, investors in the mining industry are more than happy giving their money to companies because once metal prices take off, investors start feeling very bullish and they stop paying attention to whatever minor attention they were paying to financial accounts earlier. The end result is that a lot of mining companies lose discipline on money. A lot of people start living a good lifestyle. But the worst destroyer of wealth in the mining industry is because of rules of thumb that investors use when investing in the mining industry. Let's explore some of those rules of thumb. I have worked for institutional investors, and I have seen a lot of retail investors operating. They go to the deal room, they sit with these companies for 20 minutes, and come out beaming with a decision. Within 20 minutes, a lot of investors decide on whether to invest or not to invest. They forget to dissect what was told to them in the pitch they were given by these companies. But one of the worst destroyer of wealth is a methodology used by a lot of investors called ounces in the ground methodology. A lot of companies will give you the total resources they have in the ground, and a lot of investors then multiply those ounces in the ground by a certain dollar figure, $10 or $50 or $100 per ounce of gold in the ground. This is an assured methodology to lose your money. And that did lose a lot of people a lot of money. So a new fashion came into existence a few years back, and it was tagged as gold grade is the king. And people started investing based on how good looking the grade was. There are also other rules of thumb people employ. There's often a staking rush around any discovery. I was in Australia early last month. One company discovered some gold in the ground, and a staking rush started happening around it. Market capitalizations of those companies went up by 100%, 200%, 500% overnight for no good reason. And investors are responsible for destroying their own money. Now, really, ounces in the ground, grades, all mean something. But the only way they mean something is if you actually create an equation on what weighting those individual elements should get. Price of gold matters, ounces in the ground matter, recoveries matter, process required matters, payability matters, capex requirement matters, royalty and taxes matter. The only way to really start putting a value on these companies is to start doing a discounted cash flow model on these companies. But once I have done a valuation of a company, I'm always keen to understand the personalities of the management involved. Bad managements will always destroy value, particularly in a small company. I also spend a fair bit of my time traveling to sites, going to conferences, and actually staying in countries and cities that I'm investing in. I want to understand what a cup of coffee in that country costs, what the economy is like, what people think, and what the culture of that society is. Let's talk about the opportunities that exist for investors in the junior mining industry. And I'm going to give an image of based on the differential between value and price, and I'm going to talk a bit about merger arbitrage to provide objective numbers on how much value might exist for investors in the junior mining space. Let's look at this company. This is the company I was visiting in Australia. Last year, this time, this company was struggling to raise money at 66 cents. They were already finding gold nuggets at their project. The market did not care. It took the market many months to start recognizing that there might have been value in that project. What you want to glean out from that is that the market takes a really long time to start appreciating values in companies. Now, we are mostly talking about a very illiquid sector here. But let's look at what is probably the most liquid product in the market, gas. There are two gas stations here in the US, and across the same street, two stations, there's a price difference of 13% between gas prices at the two stations. If there can be a 13% difference between prices of exactly the same commodity, which is very liquid, you can start to imagine how much differential between value and price can exist in what is probably the most illiquid sector of the market, the junior mining sector. Let's look at this company, Sunridge Gold. This company came out with a news release in 2015. There was an offer of 38-cent cash for each share of Sunridge Gold. After the announcement, when the market opened, the share price was 24 cents. You had a 58% arbitrage upside in owning Sunridge Gold that day. Now, many people think that this kind of arbitrage would disappear overnight. It actually continued for almost 4 to 5 months. This acquisition is still going on. In February, after the announcement was made, there was a 20% arbitrage upside in owning primary gold. And there was a still 15% arbitrage upside a month later. The only reason I'm mentioning this is because so many investors fail to do primary school math, basic analyses on these companies. Moving on, these are the sources of information that I look at when I try to analyze these companies. I look at the financial documents, which are available on a quarterly basis. I read the technical reports, and I want to understand how much salaries the managements are getting and how much they own of the companies that they are running. I always like to go through the blogs, ceo.ca and stockhouse.com, because I want to understand the mood of the market, what people are discussing about these companies, and often they help me out with some new information that I had not thought about. And I try as much as possible to go on site visits. So in conclusion, I continue to be very bullish about the demand for gold and commodities going forward. They have indeed done very well. The problem is your bullishness about commodities and gold should not directly translate into your bullishness about the mining industry. The only way to invest in the mining industry is to start valuing those companies using the spot price of the metals and see if they give you an upside. Rules of thumb do not work, and they are a way for investors to destroy their wealth. And it's not just retail investors who use rules of thumb to invest. Institutional investors invest millions of dollars using 10-minute meetings with managements and then using rules of thumb to value these companies. In my view, there's a massive upside for people who then focus and patiently invest in these companies. These are some of the companies that I am currently interested in. The top 4 companies are arbitrage companies. Nefson Resources has a hostile takeover offer at around $5. It's trading at $4.40. In my view, the hostile takeover offer will actually increase significantly over a period of time. There are 3 more companies that offer a significant arbitrage upside. And again, in my view, the market continues to fail to do simple math on these companies. I've also mentioned 3 value plays that I pay very close attention to, and the price that I find them very interesting as companies that I want to buy at. Ladies and gentlemen, thank you very much.